This wasn't a rally. This wasn't speculation. This was the moment the silver market crossed a point of no return. We have crossed into territory the system was never designed to survive. For years, the silver market functioned on confidence, leverage, and silence. Prices were capped not by abundance, but by belief that paper promises could always be honored, that liquidity would always appear, that sellers would always step in. That belief just shattered. What happened this weekend wasn't a crack in the dam. It was a structural collapse. The mechanism that kept silver restrained for decades failed in real time, and the consequences are now unfolding. As of the final electronic close, silver is trading just above $79 an ounce. In a single session, the price surged more than $7, a move exceeding 10%. Moves like that do not occur in functioning commodity markets. They do not happen during orderly conditions. A 10% day is not enthusiasm. It is forced liquidation. It is a distress signal. It tells us that somewhere inside the financial system, a large, leveraged participant ceased to exist. This was not retail buying. This was not speculation fueled by headlines. This was a short position being annihilated. Somewhere, a major holder of synthetic silver was forced to buy back contracts at any available price. Charts didn't matter. Technical levels didn't matter. Risk models were discarded. The only instruction left was to close positions before the account reached zero. And because this occurred during one of the thinnest liquidity windows of the year, there were no sellers waiting. The price didn't climb, it jumped. It teleported. That vertical move on the chart tells a story. It marks the exact moment when negotiation vanished from the market. In normal conditions, buyers and sellers bargain. One wants 75, the other wants 76, and price discovery happens in between. But in a liquidation event, bargaining ceases. The clearing system takes control. Algorithms execute without discretion. Every available offer is consumed until nothing remains. What we witnessed was the footprint of a collapsing whale. This confirms something critical. The silver squeeze is no longer hypothetical. It has transitioned from theory into systemic stress. First, smaller traders were wiped out, then family offices. Now institutional capital is falling. The next phase brings the bullion banks themselves into question. When silver moves 10% in a day, the issue is no longer metal, it is currency. Investors are no longer trusting the unit of account used to price assets. They are exiting the dollar, not gradually, but urgently. Gold provides the context. Gold is trading above $4,500, a level once dismissed as impossible. For years, analysts labeled it a doomsday number. Yet here it is, holding. Gold's breakout validates silver's move. Historically, gold leads and silver follows. With a long-term ratio near 15:1, silver's fair value under current gold pricing would be multiples higher than where it sits today. Even after this explosive move, silver remains mathematically undervalued. Algorithms see this imbalance. They compare gold at all-time highs with silver, still lagging far below its inflation-adjusted peak. The response is mechanical. Buy silver. Not thousands, but billions of dollars flow into the one monetary metal that is not yet fully repriced. This is why vertical charts feel uncomfortable. We have been conditioned by suppression. Slow moves, capped rallies, engineered fatigue. True price discovery is chaotic. Freedom is disorderly, and silver is no longer constrained. Now consider the timing. It's Saturday. The screens are frozen. Price is locked, but psychology is not. Headlines are beginning to circulate: bank stress, fund failures, settlement delays. Rumors of missed deliveries are spreading. This creates an unbearable pressure cooker for anyone holding paper exposure. They are not asking about price anymore. They are asking whether the exchange will open, whether brokers will be solvent, whether contracts will be honored. That fear drives capital out of paper and into physical metal. Dealers are pulling inventory. Websites show sold out, maintenance, or call for pricing. These are not marketing tactics. They are emergency responses. When software cannot keep up with price velocity, dealers stop quoting. On the street, silver is already trading far above the posted spot price. Triple-digit premiums are emerging. When official prices and real-world prices diverge, the currency has failed. This is the definition of a monetary crisis. When goods cannot be obtained at the published price, the unit of account is broken. Paper claims mean nothing when vaults are empty. What we are witnessing is a pivot in financial history, away from promises and toward possession. Attention now turns to the exchange itself. Futures markets operate with circuit breakers, limits designed to pause trading if prices move too far, too fast. With silver closing near 79, even a modest gap higher could immediately trigger a limit, a halt when trading resumes. If that happens, the market freezes. No buying, no selling. Just a locked screen. For short sellers, this is a nightmare. Losses mount while exits are blocked. When the market reopens, it often gaps higher again. This creates cascading lockups that can persist for days. We've seen it before in nickel, in lumber. Silver is next. A halted market is not bearish. It is proof that demand has overwhelmed infrastructure. Volatility after such halts is extreme. $10 swings within hours become normal. This is not an environment for leverage. Margin traders will be destroyed by the oscillations. Ownership, not exposure, is what survives. Now layer in the calendar. January is approaching. Funds that plan to allocate in the new year are staring at prices they never expected. They missed 70. They missed 75. Faced with momentum, institutions do what they always do. They chase. Performance pressure forces action. A 10% move attracts capital. It does not repel it. Early January could see enormous inflows hitting an already broken market. Yes, pullbacks can happen. Profit taking is natural. A drop from 80 to 75 would not invalidate anything. In vertical markets, sharp retracements are simply resets. They shake out weak hands and invite larger players. The trend remains intact because the supply is gone. And when markets move violently without a clear headline, it usually means the headline hasn't arrived yet. Price moves first. Information follows. Someone knows something. A bank failure, a geopolitical escalation, an export restriction, we don't know which, but the market does. By the time it's public, price will already reflect it. This is why price action matters more than narratives. The chart tells the truth. News merely explains it after the fact. So what should holders do now? Stay calm. Audit exposure. If silver is held in unallocated accounts or synthetic vehicles, reassess counterparty risk. Read the fine print. Understand what you actually own. This weekend is not about trading, it's about security. Because when a market of this size moves 10%, losses are not absorbed quietly. Futures trading is zero-sum. For every winner, there is a loser. Retail traders cannot survive a $7 move. The entities on the wrong side are massive institutions with balance sheets comparable to nations. Reports are circulating from major financial centers suggesting missed margin calls by clearing members. If a clearing participant fails, the exchange's default fund is tapped. If losses exceed that fund, remaining members are forced to cover the gap. This is contagion. One failure weakens others. Liquidity evaporates. Trust disappears. This is why bond markets are showing stress. The silver short was not an isolated trade, it was structural. When it snapped, shockwaves rippled outward. If banks stop trusting each other, credit freezes. Central banks respond the only way they can, by printing. And printing accelerates the very metal surge they are trying to suppress. It is a self-reinforcing trap. Industrial buyers understand this. Corporations reliant on silver, electronics, energy, transportation are not watching charts. They are watching availability. When price moves this fast, supply chains seize. Refiners pause shipments. Mines delay deliveries. Force majeure clauses are invoked. Contracts are canceled. Manufacturers are then forced into the spot market, bidding directly against investors. This is where the real battle begins. An investor wants silver as protection. A manufacturer needs it to keep factories running. The winner is whoever pays more. Industrial demand is price inelastic. They will pay whatever it takes. This is how 10% becomes 20. Dealer behavior confirms it. When pricing disappears and manual quotes replace automation, inventory is critical. No dealer with abundant supply pulls pricing. They do it when stock is scarce and replacement cost is unknown. Meanwhile, gold continues to rise, but silver is outperforming by an order of magnitude. This is the high beta phase. The gold to silver ratio is collapsing, attracting ratio traders who sell gold to buy silver, amplifying pressure. As that ratio compresses toward historical norms, silver's upside expands dramatically even after this surge. Retail traders will be tempted to short. That would be catastrophic. Parabolic moves can remain irrational longer than accounts remain solvent. Buying physical metal unlevered is fundamentally different from trading contracts. Volatility will destroy margin accounts even if direction is correct. Asia opens first. Shanghai will see the US move and respond. Given China's industrial needs, panic buying is more likely than profit taking. If Asian prices gap higher, Western markets must follow. This becomes a gap-driven market. Moves occur while screens are dark. Political reaction will follow. If silver approaches triple digits, governments will notice. Green energy costs rise. Inflation metrics worsen. Officials will blame speculators, threaten investigations, even hint at controls. Every such headline confirms scarcity. It does not suppress it. Zooming out, this is part of a larger rotation. Capital is leaving paper assets and moving into tangible ones. Debt is unserviceable. Supply chains are constrained. This cycle mirrors past commodity supercycles, but with far greater leverage and far less inventory. Technical analysis becomes irrelevant. Flow is all that matters. Volume confirms the move. This was not a thin melt up. It was a high-volume battle and buyers won. Overhead supply has been cleared. Vaults are draining. The path ahead is being paved by absence. Preparation now is mental as much as financial. Security matters. Privacy matters. Planning matters. Have an exit strategy, not for today, but for the future. Swaps into other real assets, not paper. The suppression era is over. Price discovery has begun. The beach ball is no longer held underwater, it is accelerating upward. We are living through one of the longest weekends in modern financial history. Markets are closed, vaults are locked, but panic is active. Emergency meetings are happening behind closed doors. Balance sheets are being stress tested. Survival is being calculated. This is no longer just a silver story. It is a clearinghouse story. It is an industrial supply story. It is a confidence story. And when markets reopen, the silence ends. Silver at 79 was not the destination. It was the signal. The system broke, and this is only the beginning.